Hello, everybody. Welcome. It's October 7th, Friday, October 7th. I'm Jason Labrum, the founder and CEO of Intelligence Driven Advisors, here with Thomas Ohanesian. And we wanted to get in front of you, our clients, with just a quick update on volatility. You know, we've done this before. These are the times when we want to make sure that our clients feel the love and know that we are minding the store and making sure that things are okay. And we're going to give you a little bit of education today to try and help ease the uncomfortableness of the current volatility that we're experiencing in the market. It's not fun. We know that, but we've been here before. We will get through this. And so we're going to give you just a few quick updates on some information and some historical looks at markets and how they've behaved so that you can hopefully feel more comfortable and drive true financial peace of mind. So with no further ado, I'm going to go ahead and jump into the slide, and I'm going to start talking about a couple things here, and then Thomas is going to also talk a little bit as we go into a couple different slides. So first thing that I want to address is this volatility that we're experiencing. It's not fun. But the one thing that we have to know is it is normal. Volatility has always been a part of investing. It's not new and it's not different this time. It does have a different name and there's a different reason why it's happening. But we've experienced volatility continually since markets were created, and we will continue to see volatility forever going forward. If it was easy and the markets just went straight up on a regular basis all the time, then there would not be the financial reward that there is because you deal with the volatility. It would, if it was too easy, it wouldn't be rewarding. So this chart is interesting, and I'm going to use an annotation here to show a few things just with a little spotlight. But what you see when you look at this slide is a bunch of numbers. So I'm going to break this down for you. Forget about the writing up top. What we're talking about is intra-year declines versus the actual calendar year declines. We go back to 1980 on this slide. And the big takeaway is right here. The average, this is just the S&P 500, but it gets you a good idea of US stocks and how they perform. Since 1980, the average year experiences 14% volatility at some point during the year, at least. That's the average. And so let's break down a couple of these just to show you that volatility is a normal, natural part of investing. Go clear back to 1980. At one point during the year, the market was down from peak to trough of 17%. If you can see my cursor over here at the bottom left under 1980. At one point, the market was down 17%. Maybe cause for a lot of people to want to panic and sell or change their strategy or get out of the market. But as you see with the blue number up top here, is the market actually finished that year at 26%. I'm not going to go through every one of these, but what you'll notice, the market was down 17%, 18%, 17%, 7, 13, 8, 9, 34. Look at these years. Every single year, the market is down at some point during the year, and on average, it's down 14%. This year is worse than average for sure at the current point that we sit. However, we've had years where the market was down. If you look over here at 09 is one of my favorites. The market was down 28%. That was during the first couple months of the year, and it ended up a positive 23 for the year. Down 28, positive 23. We're talking about 50% swings. The only point being that volatility is natural, normal part of investing. We're here to help you minimize that volatility, but more important, wrap your investment strategy into your financial plan where we constantly stress test and make sure that regardless of the impending volatility that we're going to experience in the future, that your financial plan is on track. And that is the heartbeat of what we do here at IDA for you, creating true financial peace of mind. So with that, I'm going to go to the next slide, and Thomas is going to take over and talk a little bit about that slide. Here we go. Thomas, let me see if I can get you going there. There you go.
Thanks, Jason. And you brought up a really good point of, we're not just blindly looking at the markets and all getting caught up in the day-to-day market movements and volatility. we really bring it back to our clients' financial plans. And ever since we've been working with every one of our clients, from the day one that we built their initial layout of their draft financial plan, we've been planning for this volatility, and we stress test every aspect of their financial life and talk about what are the long-term projections and to achieve a specific target rate of return. So going back to the slide, the average bull market has lasted about 4.4 years with an average cumulative total return of 155%. The average bear market, on the other hand, that period has lasted about 11 months with an average cumulative loss of 31.7%, which loss, you only realize that loss if you sell. So when you look at all of these different periods of history, if you're able to be patient through those periods of temporary downside, the reward is substantial on the other end. And as human beings, the most recent period, because we have shorter term memories and we remember what just happened. So in 2020, the market, the S&P 500 was down at the trough, down about 35%, which is not a small amount of money. But because of what happened with the Fed and the recovery during COVID, the market recovered within 3 to 6 months. So as investors, we get accustomed to having that instant gratification. And then, you know what, we're about 10 months into the year now, and there hasn't been that recovery. And you know what, things could get worse before they get better. But that being said, I want, Jason, if you could bring up the next slide. Historically speaking, anytime the major markets, and right now when major market indexes are down anywhere from 10 to 30% with the NASDAQ, when you look at those periods 1, 3, and 5 years after those moments where, yes, you really have to be patient during those rough periods, and that's not the time to be looking at your statements, logging into your accounts. Me, transparently speaking, I do have a long time horizon, but I still can't stand to look at my account when it's down, because you know how hard you had to work to get that money. But I also know that 1, 3, and 5 years after those periods of market turmoil, there is a high probability. You look at where Jason's pointing out the 1 year, you have a 77% probability of having a positive return 1 year after some of those major market sell-offs. And as you can see, the 3 year and the 5 year, that probability only increases with time and the longer that you are patient through those periods. So the main takeaway with these is, once again, to stay the course. And even though we are longer term investors, and as a company, that's our investment philosophy, is focusing on long term, there's still a lot that we're doing on your behalf of rebalancing and repositioning the investments. And if you have any questions about any of the things that we're doing on your behalf during periods of volatility, you know what, that's where you should schedule a meeting with your advisor, and we'd be happy to have a conversation and go through that more in depth. So Jason, if you want to go to the next slide.
Great point, Thomas. And I just want to reiterate on this, that the odds of succeeding as an investor, just invested in the S&P 500, which we don't think is a great portfolio. That's all US, that's all large cap stocks. But I mean, if you're invested for a 1 year period, you have a 77% chance of making money. Pretty phenomenal odds. If you're invested in a 10-year period, it's a 97% chance. And I would add that if you have some fixed income in your portfolio, or you have alternative investments, maybe an annuity, or you're globally diversified, which is how we build portfolios that have small cap stocks, medium sized stocks, value stocks. S&P 500 is just large cap, just growth, that these numbers become measurably better, where you get into the 3 and 5 year at nearly 100% chance of making money. So this is about time, and this is about tying your financial plan into an investment philosophy and strategy that works for you. But it's about focusing on the things that what are you trying to accomplish with your money? What are you trying to do? And not getting taken off track by the short-term volatility. So excellent job, Thomas. We're going to end on this slide, and then we'll wrap it up. We're going to be brief today. We wanted to just be in front of you and let you know we're thinking about you. We understand how you feel, and that you're going to be okay. That is the truth. That is the fact. Given all the history that we've ever experienced and our projections forward, we do not believe that companies are going to stop selling goods and services and producing goods and services. And so as long as you own great companies and you're diversified, as long as you lend some money through fixed income, own some alternative investments, you're going to do really well. Let's take a look at this, because this slide goes into the worst one-day returns, as you can see here. And we're not talking about 1 days, right? You as investors right now have experienced 10 months of volatility and declines, and significantly more than this average of 8% right now. Generally speaking, if you look across all the markets, the average down is over 20%. So it's significantly worse than this 1 day, but yet look at the optimism that sits on the horizon for us. Even with the average 1 days, and we've gone way beyond 1 day, 1 year later, the average return was 30% positive. 3 years later, average return is 12. 5 years later, 11. You see it starting to go back to the mean there and the average annual return of equities. But again, we're talking about just the S&P 500 because this has the most data and the most historic data that we can look at. I would submit that you, as a client of IDA, and your diversified portfolio that's globally diversified with some fixed income in it, some alternative investments in different asset types, that your numbers even look better than this proposed here. So we'd love to under promise and over deliver, and I think we can do that by looking at this data that's focused on the S&P 500, because again, that is not a very well diversified portfolio, the S&P 500. And if you're a client of IDA, you do have a well diversified portfolio. This is about patience. This is about staying focused on your purpose. This is about your psychology of money. We're reading the book right now as a firm. We do a book club, and we're reading the book about the psychology of money. It's a great book, by the way. I highly recommend it. And it just talks about how personal investing is, right? This is so personal, and that's why it means so much to us. It's our hard-earned money, but it's very personal because all of our hopes and our dreams and everything that we've worked for is tied up into maybe the market and how it's behaving and your money. That needs to be really turned and focused on your financial plan, looking at probability analysis, which we've been doing for our clients since the beginning of our firm's origins. And when we do that, we know that there's going to be volatility ahead, but we know we've already projected and we've already planned for that. So it is a great time to take a deep breath, know that this is not going to last forever. We will come out of this. We will hit new market highs. Your plan will succeed, and we are here for you. We want most of all that you come away from this short video and presentation knowing that if you call us, you're not interrupting us. You're not annoying us. This is when we really want to be here for you above any other time, is when you're feeling stressed or you're not feeling happy about the way the market's behaving. Let us share some of this information with you, but in a really personalized fashion. And I think it will drive true financial peace of mind, which is what we aim to do. And that is our overall objective at this firm. That is our mission, is to give you true financial peace of mind. And we have to have success and performance behind that. We believe we will. Thank you for your continued trust and confidence. We do not take it lightly, and we are humbled by it, and we will continue to strive for excellence for you and pursue better with your personal wealth management plan. Thomas, thank you for presenting with me today. And
absolutely.
Thanks again to you, our clients. We are very grateful for what we get to do for you, and it's a lot of fun. These times are a little tougher than normal, but this is where great investors shine, and where people who are successful do certain things and behave certain ways, and we're here to help you do it and have financial peace of mind on the way. Again, thank you so much for your trust and confidence. We'll be in touch. We look forward to hearing from you, and we will be reaching out to you for your regular review. Thank you.